Hey, how's it going, everybody? This is Micah from WallStreet IO, the number one backtesting platform for swing traders, with a quick update for you today. Right now, we're going to talk about Apple. Currently, we're still, unfortunately, in a little bit of a downtrend over the last couple weeks. We've had a low, we've had another low, and we've had another low here. And each one of these little attempts to bounce have basically failed. Now, today I want to talk about a couple ideas around how to identify these failure points before you trade them, so you can potentially avoid these kinds of trades, and at the same time you can make sure you participate in the big moves. So first and foremost, what we're looking at right now is a daily chart. However, instead of a regular candlestick chart like this, we're using a Heikin-Ashi chart. Heikin-Ashis help us identify cycles. I call them payday cycles. Here's one, for example. That's a bullish payday cycle. Here's another bullish one. Here's a bullish one. And these have been basically bearish payday cycles, right? There's a couple bearish payday cycles. Now, what we're going to do today is we're going to talk about this idea of when is it safe to take a bullish payday cycle, and when is it riskier to take a bullish payday cycle. And to do that, we're going to use something really easy. We're going to use the 21-day simple moving average. And what we've identified here at WallStreet IO, using our backtesting and analysis tool, is that when Apple's above its 21-day simple moving average, you're safer getting into a bullish payday cycle. And when it's below its 21-day moving average, which is this here, when it's below it, you might want to avoid taking that bullish trade. It's more likely going to be a false start. So when we looked at this whole idea of a payday cycle, which again is a really great profitable strategy on its own, however, from time to time, we have these things called false starts. Again, a false start happens when it looks like we're going to have a pivot, and instead of showing follow through, we basically have a false start. Now, again, when Apple's below its 21-day moving average, those false starts are likely to be costly losers. And when it's above its 21-day moving average, you're a little bit safer getting long those bullish payday cycles. In fact, when we take a look at the results, they're pretty amazing. Over the last year, we have a 70% batting average, a 4 risk reward, and 20 trades a year. This is a very active strategy. 20 trades a year is a lot. Now, what's most impressive about this is that it's been profitable every year for the last 10 years, and it's really outperforming the buy and hold of the stock. So while the stock has all these up and down movements, this strategy really helps you identify the highest probability times where it's going to move up, and it helps you identify those high risk times when maybe you should avoid getting long. So what I want to do is I want to walk you through the actual strategy right now, and I'm going to show you where to find it so that you can load it up into your WallStreet IO membership here at your account and take a look at it and maybe follow it and get a notification for it. So here's the way the strategy works. I'm going to explain it to you, and then I'll show you the actual rules. Again, we want to buy Apple on the first green bar of the payday cycle when it's above its 21-day moving average. And we want to sell it if it goes up for 9 days in a row. We want to sell because we know that it's very uncommon for this to cycle for more than 9 or 10 days in a row. So we want to go ahead and take profits. So buy on the first green, but only when it's above its 21-day. And we want to sell if it goes up for 9 days in a row. Or we're going to sell if it happens to drop below its 21-day. We're going to go ahead and sell on its third day, which means instead of waiting for 9 days, it's very unlikely to last 9 days if it's below its 21-day. So if it's below its 21-day, we want to sell on the third day, right? Because it's likely going to not last that long. And just as an added safety, if we ever have our first red day, we're going to go ahead and stop ourselves out, right? And again, the results have been pretty incredible. Here are the 3-year results for the strategy. 3.1 risk reward, 56% batting average. Again, you're looking at about 18 to 20 trades a year, and the strategy has been profitable every year for the last 10 years and is really outperforming the stock. If you take a look at this chart up here, it shows you the green line is the strategy and the gray line is the stock. During the periods where the stock has huge downtrends and declines in price, this strategy performance goes sideways. And then when the stock carries on and starts going up again, the strategy starts to profit again, which is exactly what you want to see. So let's go ahead and walk through the actual backtest here in WallSteet IO in our backtester. So we're going to go ahead and buy on the first green payday cycle bar. All of our backtesting is routed to the closing price, right? But we're only going to buy on that first green one when the stock's above the 21-day simple moving average. That's what this reads here. We're going to sell for profit on the 9th bullish day, or we're going to sell for profit on the 3rd bullish day, but only when the stock, if it drops below the 21-day, right? Because we've identified the 21-day as this momentum point where if it's above it, we're going to probably last a longer amount of time in the cycle. And if it's below the 21-day, we should take profits on the 3rd bullish one and not wait for the 9th one. And just as an added safety, we're going to have a 3rd sell condition here that says, hey, if we ever get our first red one, doesn't matter if it's above or below the 21-day, if we ever have our first red bar on the Heikin-Ashi chart, just go ahead and close it out. So these very sophisticated yet simple rule conditions of buy when this happens and sell for profit when this happens, or sell for a stop when this happens, this kind of advanced strategy development is really only available at WallSteet IO. We're basically the first ones to ever build a drag and drop backtester that can handle this kind of logic inside of a strategy, which is really cool. And the benefit to that, of course, is I get to find these cool strategies and think of these things and then share them with our community so that everybody can benefit from the strategy. Again, because I think it's a good one and it can help you potentially eliminate some of those false starts. So if you're currently a member at WallSteet IO right now, what I would encourage you to do, click on this community icon right here. At the very top of it, you'll see this strategy and you'll see this link. If you click this link, it's going to take you, voila, to the strategy that I just talked about. It's going to take you exactly right to it. If you want a notification for when the strategy starts and stops, you simply click follow. And I've named it, once you click follow, you can rename it. I've named it Payday Cycle 21-Day Moving Average to help remind myself. Once you've done that, it'll show up under Scan, under My Strategies for Current Stock, and it'll show up right here for you. Okay, so again, I hope you enjoyed this quick video. This is going to show you a really simple way to use payday cycles with the 21-day simple moving average as a way to identify risk on or risk off. This is Michael Lamar. Let me know in the comments right below this video what you think about this strategy, and I look forward to seeing you on the inside.